Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's quickly recap the action. Into Friday's close, stocks faded hard as oil pushed back above $100, and traders started pricing the second-order problem, energy-driven inflation re-accelerating, right into an FOMC week. The vibe wasn't buy the dip, it was cut exposure, and that defensive posture, that's what we're carrying into the weekend, with headline risk still front and center. Now zoom out to the weekly view. The majors closed broadly lower. The S&P 500 finished the week down about 1.6%, the Dow down roughly 2%, the Nasdaq off about 1.3%, and small caps in the Russell 2000 down around 1.8%. The technical takeaway? Momentum's deteriorating. This felt more like distribution than a clean dip buy, and that matters because it makes the market more sensitive to weekend gaps and sets up a higher volatility reaction into Wednesday's Fed decision. Building on that technical damage, the sector tape explains the why. Over the last 5 sessions, money rotated into energy and defense and aerospace, while technology, especially the rate-sensitive megacap and AI complex, was used as the funding source. Classic inflation scare rotation. Crude above 100 boosts inflation expectations, raises the bar for valuations, and pushes investors toward cash flow and real asset sensitivity. And here's the nuance. This didn't trade like a one-day headline blip. Persistent leadership in energy and defense says institutions were actively hedging tail risk. Over the weekend, it's all about what hits the tape while markets are closed. The evolving story is Iran war fallout and possible disruption around the Strait of Hormuz. Markets are treating that as the macro accelerant. It feeds straight into inflation expectations and growth risk. That keeps Sunday night futures gap risk elevated. Escalation pressures equities, while any credible de-escalation could spark a fast relief rotation back into growth. And a quick sentiment tell, this is a signal, not a catalyst. But because crypto trades 24/7, an outsized Sunday move in Bitcoin can hint at Monday's risk-on or risk-off posture. For Tesla, the biggest overhang this year hasn't really been competition. It's been controversy. Elon Musk's high-profile role in the Department of Government Efficiency, or DOGE, has split the investor base. But Cathie Wood sees that as a massive strategic edge. She argues his proximity to federal streamlining can tear down the regulatory red tape that's kept so-called unsupervised FSD grounded for years. We're already seeing moves. Tesla just filed key safety data with the TSLA, aiming for a nationwide autonomous rollout that sidesteps a lot of state-by-state friction. Critics are focused on brand damage and a softer Europe, but Wood's locked in on the deep tech breakthroughs. With the third-generation Optimus robot targeted for mass production in 2026, the goal is clear: use a deregulated American backdrop to launch the world's first fully autonomous fleet before the decade is out. Now, for the cold water, no matter how bullish you are on AI, the macro backdrop just took a violent turn. The war in Iran has effectively shut the Strait of Hormuz, pushing Brent Crude above the $100 line and keeping it there. This isn't just about what you pay at the pump, it's a structural inflation shock the Fed can't ignore. Friday's data drove it home. Core PCE ticked up to about 3.1%, confirming inflation's stickier than most expected. That puts the Federal Reserve in a stagflationary trap. They can't cut rates to help a slowing economy if energy keeps pushing prices higher. We're heading into next week with a 10-year yield around 4.28% and a market that's fragile under the hood. AI efficiency is a long-term hedge, sure. But right now, we're looking at a regressive tax on the consumer that can choke the very growth Cathie Wood is betting on. While the broader market's reeling from a brutal week, Cathie Wood and ARK Invest are doubling down on a vision most of Wall Street still doesn't see. Her latest work sticks with a staggering $2,600 price target for Tesla by 2029. And here's the kicker. It's driven almost entirely by the robotaxi. ARK argues that roughly 90% of Tesla's future value isn't in selling cars at all. It's in the software-style recurring revenue of an autonomous network. With Cybercab mass production slated to start at Gigafactory, Texas, this April, we're moving past the purely speculative phase and into a commercial ramp. Wood sees a pivot from roughly 15% auto margins towards something closer to 80% software margins. If she's right, this isn't just an automaker, it's an $8 trillion AI powerhouse that could reshape the S&P 500. For 2026, this is the ultimate conviction trade. Heading into the next open, NVDA is one of the cleanest tells on whether the AI trade's ready to stabilize. This past week, the stock came under pressure as the market derated long-duration growth on the oil-driven inflation scare. Why that matters: NVIDIA still acts like the sentiment barometer for the whole AI complex. If it can reclaim leadership after Wednesday's Fed messaging, the Nasdaq can firm up fast. If it stays heavy, that's usually a sign the market's still degrossing. Apple mattered this past week because it's a portfolio core. When Apple leaks lower, the indexes often feel heavier than the headlines suggest. The stock got pulled down in the broad megacap de-risking, and on concern about consumers facing an energy-driven inflation shock. Heading into Monday, the key question is simple. Do buyers show up at support for a mean reversion bounce? If not, Apple's passive weight can quietly amplify downside in the S&P 500 during a headline-driven tape. ExxonMobil was a defining leader this week because it confirmed the core narrative: oil up, inflation risk up, and rotation into real assets. With crude back above $100, energy traded like the hedge. Looking into Monday and the rest of next week, watch whether Exxon keeps trending or starts to roll over on any de-escalation headlines. A rollover in energy leadership often becomes the release valve that lets growth rebound. Lockheed Martin is the clean read-through on geopolitical hedging. This week, defense strength showed investors weren't just trading headlines, they were willing to pay for protection. Heading into the next open, the setup's straightforward. If Lockheed holds its relative strength, the market's still prioritizing safety. If it fades quickly on calmer headlines, that's your clue. Traders are rotating back toward risk. Tesla sits right at the crossroads of this market: high beta risk appetite and big long-term AI narratives. This past week, it traded like a textbook de-risking target as macro uncertainty picked up. Why that matters for next week? Tesla can act like a volatility amplifier. If the tape improves after the Fed, it can snap back hard. But if inflation fears keep driving the story, it's often where sellers press the most. Layer on the ongoing split around regulation and politics, and you've got a stock where every narrative swing can widen the price swings. Now let's get ready for the week ahead. The main event is Wednesday, FOMC day. You've got the rate decision, the statement, and the economic projections at 2 p.m. Eastern, followed by the press conference at 2:30. Around that, the calendar's full. Empire State Manufacturing on Monday, housing data Tuesday and Thursday, PPI Wednesday morning, then jobless claims and the Philly Fed on Thursday. And hanging over everything is the Iran and Hormuz situation. If oil stays elevated, the market will dissect every word from the Fed on how it's thinking about inflation risk. To wrap it up, this week closed in risk-off mode, with energy and defense leading and growth taking the hit into a Fed decision week. Over the weekend, stay alert to headlines around the Strait of Hormuz. That's exactly the kind of catalyst that can gap futures before cash even opens. Heading into Monday, know your levels, your position size, and your risk plan. Get some rest, reset, and we'll be ready for the next open. Thank you for watching Cathie US Stock. Stay curious, stay calm, and we'll see you next time.